welcome to another episode of the Capital Playbook. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital. We're very excited to have you here with us. We have a very special guest, Mr. Rob Anderson. He's with BV Capital. And we're going to talk to you in the audience, especially individuals who have thought about making an investment in commercial real estate. Mr. Anderson represents a firm that's a broker-dealer, among other things, and we'll talk about some of the nuances involved in making an investment and what that could be like, especially in a market like the one that we're in right now. But before we get started, I want to talk to you about something that is very important to me, and perhaps it's important to you, but it has to do with the affordable housing crisis that we are facing here in the United States. A crisis that's causing some to even go homeless. So we'd like to urge individuals to support our nonprofit organization, Project PRC. So go to projectprc.org today and make a donation. And remember, a little bit goes a long way. You may be familiar with our 10 for 10 program. You remember all you have to make that program work is $10 and 10 friends. So if you donate $10, and then you get 10 of your friends to donate $10, and you get 10 of their friends to donate $10, we will have an impact on this affordable housing crisis. Now, with that being said, please join me in welcoming our guest, Mr. Rob Anderson.
I appreciate it, Charles. Excited to be here.
Well, we're excited to have you. You know, a lot of people think about real estate, either from the perspective of wanting to run out and buy some real estate, or maybe being a passive investor in real estate. But your perspective is a little more unique in that you raise capital from individuals to put into real estate transactions. Is that correct?
That is correct. A lot of that started from being a guy who owned a bunch of rental houses way back in the day too, though,
Yeah.
And I got tired of all the day-to-day stuff.
Right.
And, I wanted to retire from my real estate. So I had a day job, a really good day job.
Mm-hmm.
I was working at a Wall Street-like firm.
Right.
Selling investment products to folks like you and I.
Mm-hmm.
And I did that for almost 20 years while building my little rental empire on the side, and realized I already had a good job. Why am I creating a second job that's taken away from my good job?
Mm-hmm.
And so I was an active investor, right?
Mm-hmm.
And so when I discovered passive real estate investing and how that works, and then I could invest with a pro that does this for a living, a professional company, and they have all the different things and know all the stuff that I don't know about.
Right.
And I can make the same or better returns. I don't have to lift a finger. I sold everything.
Yeah. Yeah.
And I started just investing that way. And I tell you what, it's better on the home life too, because when you're floating like 5, 6, 7 mortgages, mama gets a little irritated sometimes. So.
Right. And you're taking a lot of risk.
Well, you are.
Yeah.
You are. And then you get phone calls, and you got to handle stuff, trash and things that break and tenants. And it's nice to not have to deal with that, but have a professional company do it, and you just kind of read the quarterly update.
Okay, very good. So tell me a little bit about BV Capital. How did it get started? And I know it does more than just handle investments, but just give us a little rundown on what BV Capital is all about.
Sure. We raise money for institutional real estate deals that most people may not be able to find on their own.
Okay.
So what really irked me over the years is I was working with some of the top financial advisors in the country, mainly here in Texas. And I had this access because I had a really close friend that was a real estate developer, and he would let me invest with him. That's when I found passive investing.
Okay.
Right?
Right.
Well, the only reason I knew that is I had a friend
who was
that came in.
Yeah, right.
Well, if you don't have that friend,
you don't get the opportunity.
or if you're not in the specific zip code in your area or the right country club in your area, you never get to see this stuff, even still today.
Right.
So this was before the Jobs Act, when you really didn't get to see things.
Right.
And it always bothered me, right? I mean, I was in the mutual fund business, and there's nothing wrong with mutual funds. They serve a purpose, right? But these are really fascinating investments. I always wanted to diversify with real estate. Most of the country's wealth had a vast majority of their wealth is from real estate. If you go look at the past people that have been very successful, and I always wanted to get into it, and a lot of people want to get into it, right? And that's when they end up buying rental houses, or they read Robert Kiyosaki's book back in the day, and next thing, that's what I did,
right?
And then, long story short, I eventually retired from that that business and basically became a real estate investor full time and sharing this story with others through what we do. Right. And so we raise money to go into our development projects.
Okay.
If we're building a multifamily project ground up, or if we're buying a triple net property, or whatever it is that we're doing, an industrial building, something that either creates cash flow or will eventually create cash flow that we can sell to an institutional buyer someday and split the profits with our investors, right? No different than what you guys are doing.
Right.
And just the ability to have the access for people really has driven me.
Right.
I really like that, because even today, it's hard to get the access, and then do you trust what you're being told? There's a lot of stories about websites out there and whether they're doing the proper due diligence and whether they're not. And it's especially in today when things aren't as perfect as they have been in the past. I really enjoy doing that. A lot of developers don't, because it's a lot of smaller checks, dealing with individuals, having relationships. And then on the other side of that, you have a lot of people where I was 10 years ago that are starting to sell off their investment properties, and they're trying to figure out how this 1031 thing works, and what do I do? I don't want to pay my taxes, but I also don't want to go buy another home. And so we got into the Delaware Statutory Trust business, which is a DST, which is a passive 1031. So being able to help people, once again, move from active to passive has kind of been the path that we've been on, and we do a lot of that now.
Okay. Well, let's talk about that, because I know a lot of our investors are interested in the DST. Some have heard about it, but may not understand the practicality of it or the functionality of it. So kind of walk us through, and just imagine I'm 2 years old, and you're going to walk me through the advantages and the opportunity with these DSTs, or these Delaware Statutory Trusts.
Well, the number one reason you do it is not to pay tax. Okay. So you have to first.
Well, it defers tax. You have to pay the tax eventually.
Well, not to pay tax today.
Right. There you go. Okay. Because that's very, very important. I'm a former tax guy, enrolled agent, so finance guy. So
Uncle Sam's always going to get paid.
You're going to get paid. It's just when you pay him, right?
Well, but it's funny. One of the neat things about it is the estate planning tool. They call it swap till you drop. It's a horrible phrase, but the analogy is there. And so you exchange.
Right.
And then when you pass away, your heirs get what's called a stepped up basis.
Right.
And so they actually do skip out on all that tax if you do it that way.
Okay.
Now,
I need to talk to your people.
It's a little morbid because you're thinking about, the end.
Right.
But it's a great estate planning tool for the right families.
Right.
Back to the first conversation, I had somebody call me the other day wanting to do a 1031 exchange, so they asked about our DSTs. I started talking to them. I go, your tax bill is nothing. Pay the tax. Right. We didn't make any money on that, but that was the right thing to do. Right. So you first have to look at the tax you're going to pay. If that tax is small, you don't even need to do this. A lot of people like to do it because you can actually buy a vacation property and rent it through 1031 proceeds, which is kind of nice, and then use it yourself. Right. And so the idea is you sell an investment property that's appreciated considerably. Or you've depreciated it considerably, because what a lot of people don't realize is there's a recapture when you sell,
tax.
Right? And so it's not
I'm sorry, I didn't mean to interrupt you, but this is a very good point, and I'm glad that you mentioned that. You merchant developers, if you're holding that asset for a year or two and you know you're going to sell it, then be very careful about how aggressive you are on depreciation and amortization, or these non-cash events or taxes or expenses, non-cash expenses, because you will have to pay that back in the form of a recapture tax. So continue.
Yep. It's a great point, because the tax professionals that are out there selling bonus depreciation, accelerated depreciation, cost seg, whatever it is, Well, that's great if you hold it forever.
Exactly. Exactly.
And when values have inflated so much, like they have over the last 3 or 4 years, you're not going to hold that.
Right.
So even if you come off a hair because of what's going on today, you can still make a ton of profit.
Right.
And that profit is where the capital gains comes in.
Right.
Add if you're in a state that has a state income tax on top of that, like our friends in California or New York or somewhere, and then it can really compound, and your tax bill can be as much as 50%.
Absolutely.
And now, if you've held it forever, you got to watch that cost basis.
Right.
We had somebody who had a negative cost basis.
Really?
100% of that gain was going to get taxed.
Wow.
What do you think they did? They 1031'd into a DST.
Yeah.
Now, a lot of folks will say the drawback on DSTs is they're not massive money makers. They're also not designed to be.
Right.
They're designed to be a little bit more of a secure institutional grade investment because you're trying to take some risk off the table too. Right. And so instead of having a warehouse or whatever sort of investment property somebody has, when they sell it, the idea is to go passive. You go into on a fractional basis into a large institutional property.
Gotcha.
Like, for example, our last one was $60 million. Well, if you sold a property for $1 or $2 million, you can't necessarily go buy that $60 million property.
Right.
But if your tax bill is pretty significant on that sale, you can come in on a fractional basis, maintain your exchange, a 1031, and not have to do any more work. Right. Now, you got to understand what you're going into.
So let's break this down, because I want to make sure the audience, this is really good information. So I own a property, and we're just going to use a scenario. Let's say it's $10 million, use round numbers because I'm simple.
Okay.
And my cost basis in the deal is $4 million. So I have a $6 million gain.
All right.
Now, I'm exposed to capital gains tax on that $6 million unless I go into a 1031 exchange. Now, a traditional 1031, I would go find another property, and I'm back in the landlord business.
Correct.
Only problem is I don't want to be in the landlord business. I'm tired. I'm tired of looking at toilets. I want to get out of it, right?
Yep.
So now I can exchange that gain into a DST, Delaware Statutory Trust. And then I can use that gain through the trust to make fractional investments in institutional quality deals.
That's correct. That's correct. So
Wow.
if you sold let's say it's a multifamily property that you sold for $10 million, you have a $6 million gain plus the depreciation, whatever that is. Now, you're in Texas, so you don't have a state issue. People in other states are going to have an additional income tax at the state level. If you make good money, it's not just 20%, it's 23.8? I forget what it is. So it's that plus the depreciation plus the state. That's kind of where you get to, right?
Yeah.
So what is that tax? And if that tax isn't worth paying, that's kind of where you look at the exchange.
Interesting. Now let me ask you this. When you exchange into a DST, are you still subject to recapture tax?
No.
Interesting.
Not at all. You defer. Like you caught me earlier, right? If you don't keep going and you eventually sell it, the government's going to get their tax, but you defer 100% of it. Okay, so you defer your whole basis and it just keeps going.
Right.
And then what happens is, so in your case, you could take the $4 million minus, let's just say it's 3.5 to take the depreciation. I don't know how much it was. Well, you could reinvest that and make money off the 3.5, or you could move the full 10 and make money off the 10. Now, you could go into a much more aggressive deal with the 3.5. Maybe you can make a mid-teens return.
Right.
But you can't find that in the DST space because they're not designed to be that way. They're designed.
What kind of returns are folks getting?
You're looking at high single digits.
Okay.
Right.
But it's still good. So in a sense, you're creating
mid to high. Depends on who you're looking at.
You're creating your own annuity through the DST.
You are. They typically have income in the 4 to 5% range. They used to be higher. It's come down. There's some that are less than that. Right. I don't know if those are not that exciting, but typically what we see is in that range. Depends on the year. Depends on when you do it. You can still get something in the 4s right now. There's a handful that will grow into the 5s, right? And so you just got to understand the deal. Typically, they're 5 to 7 year holds. We had a 3-year. That's rare. Most of them are in the 5 to 7 year, because really at this stage of the game is when people are looking to retire from managing the real estate, and they just want to move from something they own to something that's an investment, right? And so what I always tell people is invest in things that don't talk back.
Right. There you go.
And it's a really good analogy to say, okay, I want to go off and do something else, and now I'm going to have my money work for me here, have an income stream. It's sold. You'll make a little bit of money on it when it's sold, if it's good real estate, and then you can exchange that into something else again.
Okay. Now, what do the distributions look like, and how does that work out of a DST?
Most distributions are quarterly.
Okay. So they're going to get a check. It doesn't accumulate within the...
It doesn't. Okay, so it's not like an IRA. You can't reinvest.
Right.
So that is a question we get. It's a good question. That's taxable income.
Okay.
Right. And so if your 10 million's kicking off $50,000 a year, you're gonna pay tax on that. But like you said, you created an annuity for yourself.
Right.
And that's the idea. And you still have the asset. So the asset is paying you as opposed to your hours and your work paying you. And that's where I think we all want to get.
Absolutely.
Right.
Yeah. Well, that makes a lot of sense. And so now I remember when DSTs were starting. There was buzz around it, but you don't hear a lot of it because it seems very complex to set up. So with your company, you guys basically have structured a or multiple DSTs, right? And that DST becomes an entity that houses money from investors that you collect together to invest in other deals. Your company does. Is that correct?
Usually it's a specific deal.
Okay, so that DST is set up for a specific deal.
Right.
So when you get ready to go and so you'll get a development deal that you're looking to do.
Well, let me jump in here. Okay, so there's a couple rules.
Okay.
Most, if not all, DSTs are stabilized product.
Okay.
So we're not talking construction.
So it has to be stabilized.
Much different risk return.
Okay.
Right? So a lot of the risk is kind of taken off the table at this level.
Right.
And the reason is there's a lot of rules, you cannot refinance your debt. You have to have permanent financing.
Okay. So that asset has to have permanent financing.
It does.
Okay. And so it is a stabilized asset. It's basically in the fund, and you go out to raise. So if I'm as a merchant developer, I go out and I develop a property, I get it stabilized, and I decide that, well, right now is not the best time to sell this, and I put permanent debt, but I got to recap the equity on my development deal. Then the best thing for me to do is establish a DST, and then go raise capital so I can recapitalize the equity, get my equity people out. On that short-term equity out.
It could be, Charles, and I can help you with it.
You can help me with that? All right.
So we actually do that with our development.
Okay.
So we'll build something ground up, and we make sure that the financing that we put on it is such that we could carry it through a DST if we needed to.
Gotcha.
It's just another protection measure for the investor.
Right.
So economic cycles happen.
Right.
We never know when that...
Might have aggressive interest rates. Can't sell it the way you want to, right?
The Fed could add 550 basis points.
You get a lunatic on the Federal Reserve Bank.
Yeah, you never know, right?
Something just happened, right?
So it is good timing considering yesterday, right?
Right.
So things could happen.
Right.
And real estate is one of those things where you just need some time.
Right.
Usually, if you just have time,
right.
It's really hard to kind of have an issue if you just have the time to get to the right time to sell it and make your money. Because I don't want to get into the return analysis there, but people can look that up.
Right.
If you have the time, you can do just fine.
You will make good money on the returns.
Now, there's a couple things to know if you're going to do a 1031, which a DST is just a vehicle for a 1031.
1031, correct.
You have to have a qualified intermediary, right?
And I bet you guys are.
No, it's a third party.
Oh, third party,
No.
okay.
Think of it like a title company that would hold your money in escrow.
Okay. Oh, so broker. I mean, I know what you're saying. I can't think of what they're called. Escrow.
An escrow agent. A title company is the most probably similar. And so what happens is when you sell that property, you have to have they call them a QI because qualified intermediary is quite a long word, right? And so you have to have a QI in place. We've worked with 20 or 30. If somebody needs help, I'll give you who our favorites are. But you've got to engage them. It's not a lot of money. It's maybe most of them are around $1,200 for the transaction. And what they do is they dot all the I's and they cross all the T's and they make sure you don't mess up your exchange because there are some rules. And when you're dealing with the IRS, you don't want to mess this up.
Right.
And so the money goes from the sale directly to the QI. You can't take receipt of the funds.
Right.
If you take receipt of the funds, you've just busted your exchange.
Right.
And then really your only opportunity there is an opportunity zone fund. Where you can move the gains. Other than that, you've kind of lost your opportunity. So you got to make sure the QI is involved up front and that they take full receipt. You have 45 days from the time you sell to identify future properties that you may go into. And then from there, you have 180 days to actually have the transaction take place. So 3 things to know. QI, 45 days to identify from sale, 180 days to finish the sale. Those are kind of the main things to remember when you're looking at a 1031.
But you're going to want your money, you're going to want to do the sale as soon as possible because your money's sitting with a QI, a third party, not earning any interest.
The QI earns interest of it.
Yeah.
But you and I don't.
Right. Yeah. That's the problem.
Exactly.
So you want
to deploy the capital.
Right. You want to deploy that capital as soon as possible.
Most of our investors will have already figured out up front, even before they have the sale, where they're going to go with it.
Right.
And one thing actually is your active investors who aren't ready to retire yet, they have a great offer. They want to sell it. They're just not sure where they're going to go to. What do? A lot of times they'll use a DST company like us as a backup plan. So they want
So that way, if they can't finish their 1031 exchange, they say, well, worst case, I can just move it over to a QI. And it buys me more time.
Well, they're going to go to the QI regardless.
Okay.
But you have 45 days to identify, and if you don't, you lose it. So, I mean, that's not a lot of time. Right?
Yeah.
And so they want to go find a 7-Eleven, a warehouse, a rental property, a vacation, whatever it is that they're doing, that they're wanting to move into, another multifamily property, duplex, whatever. If they can't find something that they want to own or can't get the financing put in place in time or are nervous about it, you can identify up to 3 properties with the QI. So we tell people, hey, let me show you what we have. Use ours or somebody else's, whatever you're doing if you're doing an exchange, but have a backup plan. You can submit more than one, doesn't cost you any more money. And this way, if whatever you're chasing falls apart, you can always have the DST as a backup plan so you don't lose your exchange.
Gotcha. Well, this is fascinating information. I wish we had more time to go into more detail. So you have to make me a commitment today. You have to commit to coming back and doing another episode where we can talk more about DSTs and go into more of how some of the experiences you've seen where this has really benefited investors, and then how are interest rates really impacting the market today. But we don't have time to talk about it today, but certainly if you enjoyed this episode, even if you didn't, I want you to like the episode for me, right? Like it, subscribe, and then share this to everybody you know. This is great information on Delaware Statutory Trust, and we're certainly happy to have Mr. Anderson with BV Capital. His information is on the screen if you want to reach out to him directly to get if you have questions. But thank you again for being with us today on the Capital Playbook. And please don't forget, go to projectprc.org today/donate and make your donation today. There are homeless people. There are people that need affordable housing who's waiting on your $10 donation today. So please don't forget, make it a priority. Go and make that donation today. Until next time, we look forward to seeing you again here on the Capital Playbook.